Journal entries by Sean Dalwood. Journal entries are the means by which transactions are communicated, exemplifying the dual nature of accounting. A transaction is any economic event affecting the assets, liabilities, or equity of a business. Since the accounting equation must remain balanced for all transactions, any change must be accompanied by a second change of equal value. This occurs in journal entries through debits and credits. But what are debits and credits? I know what you're thinking, but don't worry, it's actually quite simple. Each account is comprised of debits on the left and credits on the right. These are used to change account balances, and each transaction must involve equal debits and credits. Some accounts are increased through debits and others through credits, depending upon their position in the accounting equation. The original equation, assets is equal to liabilities plus equity plus revenue minus expenses, is expanded so that assets and expenses are now equal to liabilities plus equity plus revenue. Those accounts on the left of the equation are increased by debits and are said to have a debit normal balance. Those on the right are increased by credits and are said to have a credit normal balance. In addition to this, dividends are increased by debits in the same manner as assets and expenses. Journal entries describe the date of the transaction, the accounts impacted, and the magnitude of the debit and credit, with the credit line indented. In addition to this, it includes a description of the transaction. Recording transactions in the general journal requires 3 steps. Firstly, the correct accounts must be identified. This is essential to maximize the accuracy of financial records. Secondly, the necessary debit and credit entries must be identified. This depends on which accounts required increases and or decreases. Finally, the entry must be recorded in the general journal in the correct format. For example, XYZ Limited purchased $1,000 of inventory on account on the 4th of January. The affected accounts are inventory, which is an asset, and since the purchase is on account, accounts payable, which is a liability, is also affected. We wish to increase the inventory account by $1,000, which requires a debit. We also need to increase accounts payable by $1,000, which requires a credit. Since inventory is an asset and accounts payable a liability, the accounting equation remains balanced throughout this transaction. Finally, record this information with the correct date and explanation in the general journal. Thank you for listening.